I want to be very clear. This is the disclaimer I say every single week. This is not a show that is trying to hype, pun intended, a coin and saying, go out and buy it right now. These guys are absolutely bullish on this. That is not our intention. Our intention is to really try to show some really positive ways in how to perceive investing in crypto and try to encourage you guys to start doing the same type of things and to encourage you on like viewpoints and we may not always disagree or agree. That's okay. We don't have to agree. It is really just here to try to encourage you guys on what we do and hopefully give you guys some insight, and then you can take that and move on and create your own research skills. So please don't take this as a promotional material. None of the three of us are here are not paid. At least I'm not paid. Are you guys paid?
No, you know what? If we're such good investors, the money should come from investing, not from money that we're taking from people. That's all I'm gonna say.
So
can I just add? Can I just say something really fast? Are you done, Caveman?
I'll say one more thing. This show might be important for somebody. So if you guys do me a favor right now, please hit that post button, that repost button, do whatever it is you guys do. Share it out, bring people in. Thank you for the 94 who are here. And let's take it away. Wewo, go ahead.
So I just wanted to say this. So I believe in this show so much that I just joined, I don't know, a few shows back. But I'm not going to say the show because I don't want this to be like, go buy this token. But I was genuinely curious and I didn't want to do the deep dive. And I didn't have time to watch the video. So I called Caveman and I said, hey, I'm really interested in this coin. What do you think? And he said, I'm invested in it. And I said, enough said, because I know that the research that he does, and I trust that much that I didn't even need to do the research. I was just like, okay, done. Bye.
That is not a Caveman approved something either.
That is a big compliment.
Thank you.
Just accept it and say thank you.
So really, that's how I feel. I really appreciate. I know the research is there. I know that he's just not willy-nilly going into these projects like, hey. So I was like, all right, enough said. Bye. Don't even explain it.
Yes.
I actually don't even know what you're talking about. Like, really? I don't know what project you're talking about, but
you don't remember?
Tell me after, please.
It started with a C.
Okay, Okay, we're gonna edit that out of the YouTube video. Just
nobody said anything, but I'm just saying, like, we do a good job, and I trust the information that comes out of this. So
thank you. I appreciate that. All right, let's take it away. Let's start from the top.
Yeah, let's get into it. We're gonna jump into the real world problem before we actually jump into Hyperliquid, because we got to pay attention to what problem Hyperliquid is actually going out of in order to really understand what the solution is. And essentially, this ecosystem was kind of created as a solution for one of the biggest weaknesses that we see in crypto's trading infrastructure. And honestly, there's 104 people in here. If you guys have been in this space long enough, then you already see and you know the problems. But for years, essentially, crypto traders were kind of in between a rock and a hard place, and they had to choose between two broken systems. Either you're going to use a centralized exchange or you're going to use a decentralized exchange. And both of those, as we know it, come with their own trade-offs. On one hand, you have a centralized exchange which has fantastic performance. You get the speed, you get the deep liquidity, and you basically just get an overall better user experience. But the downside is pretty catastrophic, right? You don't actually own or control your assets. You're trusting this company, a middleman, or a platform, and over the years, your trust, as we've seen, has been broken repeatedly with these centralized exchanges. We tend to see these centralized exchanges collapse. Sometimes they're going to freeze your withdrawals, and sometimes customer funds just end up being abused. And the entire industry pretty much got reminded of the brutal reality from what happens when somebody controls your assets. They control your freedom. And then on the other hand, you have your decentralized exchanges, And this was kind of supposed to fix all of those centralized problems. And the decentralized exchanges, right? We have the self-custody. We get the transparency. There's no middlemen. Most of them are on-chain verified. But early decentralized trading platforms, they also have their weaknesses too, right? A lot of them are fragmented. They're slow. They're inefficient for some professional traders out there. And they lack a lot of liquidity, okay? And this became a much bigger issue once crypto kind of evolved beyond just your spot trading, because these modern markets are heavily driven by derivatives. So it's not as simple as just buying and holding. So traders are going to go into these leverage trades or perpetual trades, or these they're arbitraging the liquidity between different assets. And these professional traders, they start to see the limitations with these decentralized exchanges, that infrastructure. These professional traders, they need the speed, they need the reliability, they need that deep liquidity. And the truth is that a lot of decentralized exchanges, they just simply cannot compete with the infrastructure that the centralized exchanges have. So we have this real world problem. We're trying to figure out how can we create the performance of the centralized exchange with the decentralized ownership and transparency. How can we get these trading professionals to come on without actually giving up custody of their assets? How do we build a blockchain system that's fast enough for serious financial markets like derivatives or over the counter without just your simple buy and sell token transfers, right? So this is where Hyperliquid kind of enters into this conversation, because essentially Hyperliquid is just attempting to merge the performance of a centralized trading system with the transparency and custody benefits of your decentralized finance. But the conversation can go a little bit deeper than that, right? We have to ask, is Hyperliquid simply just trying to exist as another exchange? Or is it actually trying to become financial infrastructure? And more importantly, as we get into it a little bit later, how does the Hype token actually capture the value of the growth that the platform could experience as more professional traders and more activity ends up kind of coming into this entire ecosystem? Would you guys like to add something?
I'll ask a question because it's important to what we're talking about. I know, and I forgot to say this, guys. If you have any questions, put them in the chat. I'll write them down at the very end. We're gonna talk about it or answer their questions. But the question is important, so I'll ask it right away. Define perpetual trade.
Yeah, perpetual trade is essentially what's allowing traders to speculate on the price movements. Whether it's going up or if it's going down, you're able to speculate on the way that the asset is going to fluctuate without actually owning the asset directly.
And usually with leverage.
It's pretty much leverage trading, right? And leverage trading is kind of what's dominating the modern markets, right? It's that the derivatives is what's dominating your modern markets. So they're trying to expand this ecosystem beyond just buying and holding. That's what a lot of traders like to participate in.
Perfect. We will.
I'm good.
Okay.
All right, let's jump into what Hyperliquid actually is. A lot of people are simply just going to try to coin it as a decentralized exchange. But honestly, I think that explanation is kind of a little shallow for this entire ecosystem. Hyperliquid is not just trying to build another trading application. From my research, I think that they're really trying to attempt to build an entire high-performance financial ecosystem all directly on the blockchain. And this is where things kind of become pretty critical, because most decentralized exchanges today, they're actually built on top of other blockchains, right? So, for example, a lot of them are going to utilize Ethereum or Solana or Base, meaning that the exchange itself is going to depend on another network's infrastructure. And inevitably, that's going to tie into that decentralized exchange on the speed. They're going to depend on the validators. They're going to depend on the throughput. They're going to depend on that blockchain's fees. But Hyperliquid does something a little bit different here. They instead of relying on someone else's chain, they actually built their own layer 1 blockchain specifically optimized for the trading. And that's really important to understand, because they are essentially designing the blockchain itself around the financial market performance, right? They're not sharing a blockchain that has a little bit of NFTs or a little bit of gaming or a little bit of memes on there, but this blockchain is specifically focused around trading infrastructure. Now, technically, Hyperliquid operates using its own layer 1 blockchain and their own consensus design. And the goal is pretty much straightforward with them, right? They want centralized exchange performance while maintaining all of that fully on the chain. And I think that that's a reason that a lot of professional traders are so interested in this ecosystem, because it's going to require an extremely high performance, right? But if the infrastructure is going to be weak here, then the professional liquidity is going to leave. And if that liquidity is going to leave, then the traders are going to leave. And if the traders leave, then the exchange dies, right? That's just the reality of trading infrastructure. So as we mentioned before, Hyperliquid is primarily focused on perpetual tradings, right? And that's really one of the biggest sectors in here. And whether people like it or not, the leverage trading is the derivatives is really the dominant part to the modern financial markets. So even in your traditional finance, they still heavily are running with derivative markets. So crypto has kind of evolved into that direction. And this is really where we start to see Hyperliquid become more than just your decentralized exchange. Because now you see that they are onboarding the liquidity, the markets, the market makers, the traders, the settlement systems, the collateral. And when you see everything that is evolved around this ecosystem, the door opens to something much larger than just your decentralized exchange, right? You start to build a financial ecosystem, and I think that that's why some people believe that Hyperliquid could evolve into a much larger on-chain trading infrastructure layer as time continues, right? I should probably talk a little bit about the Hype token itself, because that's the native token that powers the Hyperliquid ecosystem, right? So since Hyperliquid is its own layer 1 blockchain, the Hype token is directly connected to the network itself. It's not just an application, right? So inside of the Hyperliquid ecosystem, the Hype token can play multiple roles. It could be involved in the staking, the governance, securing the network, the validator participation, incentives within the ecosystem, maybe even like a little bit of fees. And I'm sure Caveman will probably jump into the applications that are built on it as well, right? So Hyperliquid, I just want you guys to remember, it's not just another trading website application, but they are really kind of building an entire financial ecosystem directly on the blockchain. So the token itself, the Hype token, is tied to that infrastructure layer of the ecosystem. And that's kind of where we're at right now.
Well said. Damn, good job.
Yes, good job, Bully. So
Okay.
do you want to jump into the team?
Good.
It's really big. I'm just kidding. Actually,
Look how cool this is. It's like interactive. What do I click on it and the guy's face pops up or something?
Definitely not the second one. Or she has the special.
Yeah, you're right.
Keep going.
Yeah, they kind of. I don't know what yours looks. Anyways, okay. So the team is the co-founder is Jeff Yon. He has a Harvard degree in math and CS physics. He's an Olympic gold medalist. He went to work as a quant at Hudson River Trading, which is one of the most respected quantitative trading firms on the planet.
Physics gold medalist.
Oh, sorry, guys. Physics, yes. I put my comma in the wrong space. So physics, comma, he is the Olympic. Yeah, thank you for clearing that up. Yeah. Then he founded a company for trading before eventually building Hyperliquid. So this part really, truly blew my mind. He turned down over $1 billion in VC funding, venture capital, because he didn't want it. And he said, and I quote, no investors, no paid markets, no fees, and no dev team, no insiders. So I'm pretty sure he was pretty serious about what he was building. So then this is the funny part, because everybody else is like pseudonymous, like we don't really know who they are, but that's pretty common in crypto. So the other founder goes, and I'm probably going to butcher this, but it's Alinzik. Does that sound right?
Ilian Inks.
Ilian Inks.
Thanks.
Yeah, that's probably better. He was a Harvard classmate of Jeff's, and he's the core technical architect of the whole platform. So the two people who built the team went to school together. There is also a core contributor who goes by the name. Do you guys want to say it? Because
You got it.
Exelon.
I couldn't. I don't know.
Aluin. I'm sorry, I butchered it. I knew I was gonna. I tried. He has a background as both a trader and an engineer. Altogether, there are about 11 total contributors on the team. No marketing department, just engineers and traders. The team relocated, and I don't know if it should go here, but yeah, so they relocated to Singapore in 2024 because of the regulatory environment. And in 2025, they made over $900 million in profit. 11 people, no marketing budget, 900 million. That's a ton of money for, yeah.
Insane.
So that's.
Can I add a couple of things to that team?
Yeah, absolutely.
It's pretty important to the narrative and connecting the dots, guys. Only reason I'm doing this. One of the big reasons Hyperliquid became respected so quickly is because Jeff worked at Hudson River Trading, which is one of the top quantitative high-frequency trading firms in the world. At HRT, he learned ultra-low latency systems, market structure, matching engines, liquidity behavior, and high-speed trading infrastructure. That experience directly shaped Hyperliquid. And then he went and founded Chameleon Trading. This was a crypto market making and quantitative trading firm. A market making, AMM, and quantitative trading firm. It's important because market makers understand liquidity, slippage, exchange weakness, trader psychology, and order flow. Hyperliquid was basically built by someone who deeply understood why traders hated existing decentralized exchanges. And she talked about the VC thing. Guys, as somebody who has been a serial entrepreneur, if somebody is willing to invest in themselves with time, that is one thing. If somebody is willing to invest time and a shit ton of their own money from the Chameleon Trading, where they got all the money from, that is absolute boss behavior. I cannot be more clear than that. So sorry, I just wanted to say those things.
No, that's, yeah, important. Bully, did you want to add anything?
You guys knocked it out of the park.
Yeah, pretty cool. Definitely a cool team. I mean, out of all of it though, the turning down the $1 billion blew my mind. Just good for them.
Can't be bought.
Definitely believed in the project they were building, I would say. All right, tokenomics.
Let's get into it.
Yeah. So last time I looked, which was pretty close to when we went live, it was trading at $61.98. The total max supply is 1 billion tokens, and they were distributed in this way. So 31% went to the community airdrop on November 2024. That's 310 million hype. And this was the largest airdrop in crypto history at the time. But it went to real users actually trading and not, people who are just stopping in and hoping for
or VCs
free airdrop
in early lockup, right?
Right. Yep. Let's see, 38.8% is reserved for future emissions and incentives. This is a long-term fuel for growing. This is the long-term fuel for growing the ecosystem. The foundation gets 6.4% of the operations and ecosystem support, and 23.8% goes to core contributors with vestings that return late 2027. That works out to about 9.9 million hype per month hitting the market. So that is some real sell pressure. That was the only negative that I saw for the tokenomics. There's zero VC allocation, none, no investors, no unlock pressure. But personally, this is the part of the tokenomics that I think is the most interesting. 97% of all trading fees are used to buy and burn hype every single day. That's roughly 21,700 hype are burned every day. That is definitely deflationary. The annualized return from free buybacks is over $616 million. And right now there are 255 million hype in circulation. Yeah, so I think the tokenomics, what do you guys think about the tokenomics?
We're giving that a thumbs up.
I have a question for you, and this is more just like a.
I hope I can answer it.
No, it's a question for you. This is where, like, I always laugh about market cap, the conversation. We know there's 1 billion coins. We know. It's not a maybe. It is going to be out there in the wilderness somewhere at some time. So is there sell pressure? Like, right now that there is. Not maybe. It's not like they're opening a door and saying, peekaboo, uh-oh, we're in trouble. We got a whole bunch of coins you didn't know about. Here it is. They exist.
Yep.
They're just looked up.
So my answer to that is actually that's one of my problems or cons or not so good is that I feel like some of the price is already expecting that. It might already be priced into what it is now already. So, yeah.
Okay.
Yeah.
Bully, how do you feel about that?
I'm sorry. What was the question?
Did I lose you at peekaboo?
You got me a little. You got me blushing over here.
How do you feel about the whole like the billions regarding the tokenomics, right? So there are 1 billion coins. Not maybe, there are. We all know there is. It's all coming eventually. So do you feel like this unlock, no matter what that looks like, do you feel like that's a non-factor for you? Like it's already built in, or do you think that should have a downward pressure on price?
No, I think inevitably this is what a lot of people tend to kind of flee from is the inflationary money supply. When you have a hard cap, this is something that a lot of investors want to look for, let alone when you have, what did you say? It was 21,700 of a daily buyback. So there is kind of that consistent movement of that within that ecosystem. And to be honest with you, I know a lot of people tend to kind of look down on the escrow with monthly releases for certain projects. And I think that when you have an expectation of what the supply is going to be, right, there will never be any more to that. Not only are you attracting the speculative retail guys, you're attracting the people who are solely investing based on pure supply and demand dynamics, really looking at the tokenomics. But you're also attracted to the people that want to participate in that ecosystem because they know their coins, as long as this ecosystem succeeds, are only going to become more important and vital to the growth of that ecosystem simply because there will never be any more.
Now, Caveman, I'll ask you the same question you just asked us. And I'll also ask, do you think that the burn affects that for you at all? The 21,700 burn rate, how do you feel about it altogether?
I think it's short-sighted.
Now you got to
That,
elaborate.
that's the easy way of saying it. I don't think that. I think when people are focused on price action, because of like past like transgressions against you, and that we've been in a speculative market, and the downward pressure is definitely real. It's a real thing for a very long time. I don't. When you see projects that are being built right here, right now, like Hyperliquid, I think it's a short-sighted vision. I think that the release of tokens into this market will be needed. So that's what I think. For a couple of things that we're going to talk about in the near future, by the way, 3 different things we're going to talk about in the near future as well. Why this is needed. But yeah, that's my easy answer to that.
All right, so we'll see that pop up in the pros and cons for this brother.
Okay, so did you have anything else you want to add, ma'am?
Nope. Did you want to add anything, guys, to the tokenomics?
So it's good. So it's for governance, staking, gas token, ecosystem alignment, and connected to the protocol revenue, right?
Yes, and also it is not needed for Hyperledger. So you can use USDC and not, yes, the token itself. But the token specifically is what Caveman just said. Thank you for that, Caveman.
That's a nice, I like that. That's an important, could you say it again for the people in the back who aren't listening? That last bit?
Wait. Oh, what I just said?
The token, vis-a-vis the use of Hyperliquid, the network.
So you don't need it to use Hyperliquid. You can use USDC. That's the part he was referring to, guys, because he has something in his back pocket.
Something we're probably going to talk about later.
It's absolutely going to come up in token value capture models.
Going to talk about it.
Absolutely coming up in my part.
Yeah. All right, so let's go to 2020. 2020. You know, there's a lot of projects that we talk about when we go back to 2014. We're going to 2017. 2020 is when this thing's, kind of starts and kind of starts. It's the pre-Hyperliquid era. Before Hyperliquid, the founders were operating quantitative trading systems, crypto market making, liquidity infrastructure. Jeff Yan and his team, when we talked about this already, created Chameleon Trading, essentially a crypto quantitative trading market making firm. This team learned firsthand why traders hated decentralized exchanges. I said that earlier, about bad slippage, about latency. This is the period that shaped the core philosophy: build an exchange that traders actually want to use. It's the key thesis for this whole entire project. In 2021, research and architecture phase. During the 2021 bull market, DeFi exploded, if any of you guys were around. Perpetual futures demanded also exploded. Centralized exchange dominated derivatives. At the time, on-chain trading felt slow. Bully is talking about it. Gas fees were terrible. Order books on-chain barely worked. Hyperliquid team reportedly began designing, as Bully said earlier, a custom layer 1, a full on-chain order book, low latency infrastructure, high throughput execution systems. And instead of building on Ethereum or Solana or Arbitrum, they chose to build a customized, optimized chain. This was very controversial because launching a new chain is much harder than launching an app. Now, the main founders, the two that, specifically the two that we just talked about, had a key strategic decision. They decided no major VC dominance, community-focused distribution, product-first approach. This immediately differentiated Hyperliquid from heavily VC-controlled protocols and token launch first ecosystems. A token launch first ecosystem, for people who don't know, is this. Alex talks about it a lot. He, the idea of like, you know what, launch a token. We're gonna make a bunch of money. We're taking most of that money, and whatever happens after, who cares? So that is a lot of times what people were doing. Important context: they did this in a year that was brutal for crypto. At the time, guys, 2022, Terra collapse, FTX collapse, massive trust issues in crypto. Now, ironically, this kind of became the perfect timing for Hyperliquid assets. Hyperliquid thesis, because the market suddenly cared deeply about self-custody, exchange solvency, transparency, and on-chain settlement. In 2023, they're off to the races. Hyperliquid launched publicly in early 2023, specifically launching the Hyperliquid Perpetual Futures DEX. The core features were a fully on-chain order book, perpetual futures, leveraging trading, and centralized exchange-style customer experience. This immediately stood out because most DEXs still relied heavily on AMMs. The major breakthrough: traders started realizing that this actually feels good to use. That sounds simple, but it's extremely rare in DeFi at the time. Hyperliquid became known for fast execution, deep liquidity, smooth user experience, and low fees. Arguably the biggest growth accelerator of 2023 was the Hyperliquid Points program. The platform launched Hyperliquid Points. Users earned points for trading volume, liquidity provision, activity, and referrals. This actually created speculation around a future token, which was huge for user growth. And there was a lot of FOMO because it's like, oh, they're going to launch a token. We got to use it. Many traders started using Hyperliquid expecting a future airdrop. Hyperliquid became popular among high-frequency traders, leverage perp traders, advanced DeFi traders, crypto native speculators, and market makers, not the big institutions of Wall Street. In 2024, it was the explosion year. 2024 was the year Hyperliquid went from niche trader platform to one of the biggest stories in crypto. What was the major event? Well, it was the Hype airdrop. November 2024, Hyperliquid launched the Hype token, distributed roughly 31%, which is what we said earlier, of supply to users and community. This became one of the largest airdrops in crypto history. At peak valuations, the airdrop was reportedly worth billions of dollars. Unlike many airdrops where users dump and leave, Hyperliquid actually saw more user growth, more deposits, and trading activity afterward. Reports showed at the time that there was over 1 billion USDC inflows after Hype launched. The TVL grew from 56 million to $2.1 billion by the year end. And why the airdrop mattered? Well, it created massive goodwill because users benefited heavily. VCs weren't seen dumping immediately. Traders felt rewarded. This helped create almost a cult-like loyalty amongst its users. And Hyperliquid's daily trading volume reportedly grew from roughly 1 billion daily highs to peaks around 15 billion daily in volume by late 2024. And open interest exploded as well, from 178 million to 4.3 billion. Hyperliquid introduced the Hyper BFT consensus and ecosystem upgrades. Hyper BFT consensus or HIP token standards, staking systems, ecosystem infrastructure upgrades. All of this just helped improve speed, scale infrastructure, and support for future ecosystem growth. Hyperliquid became known for listing hot assets first, a huge competitive advantage. Traders increasingly viewed Hyperliquid as the place to trade new, highly anticipated tokens first, especially for perp launches or meme coin speculation and volatile trading events. This created stronger trader network effects. Speaking of network effect, Chainlink officially added Hyperliquid to the Chainlink ecosystem directory, making CCIP fully compatible with Hyperliquid. By December, as Hyperliquid became larger, security and decentralization criticism increased. There was concerns included validator concentration, decentralized questions started coming up, and governance concentration. And there were security risks. Specifically, a MetaMask security research reported that North Korean linked Lazarus addresses interacted with Hyperliquid. This caused fear around reconnaissance activity, future exploits, and security vulnerabilities. People became nervous because crypto remembers Ronin, Harmony, and other more recent exploits in crypto. But there were no catastrophic protocol exploits at the time. The concern was more reputation and security monitoring related. By the end of 2024, Hyperliquid controlled roughly, by 2024, Hyperliquid controlled 56% of decentralized perpetual futures trading market share. 56% of the share. This was massive because it started seriously competing with DYDX, GMX, and centralized exchanges. 2025, Hyperliquid becomes a giant. This was the year Hyperliquid became dominant. By early 2025, Hyperliquid reportedly controlled 70% of decentralized perpetual futures volume. By mid-2025, weekly trading volume averaged 47 billion, with peaks of above 78 billion in a single week. Open interest also exploded from 3.2 billion in late 2024 to 15 billion by late 2025. Hyperliquid started approaching centralized exchange scale, which we're going to go into TAM after, so I won't say anything. I won't take away his shine. But what they had done in such a short time, it's enormous. An enormous achievement. I actually literally wrote that in my script. That's crazy. What I just said. I'm not going to take away your shine. By early 2025, Hyperliquid reportedly controlled 70% of decentralized perpetual futures volume, and all the pieces started coming together. One of the most important technical milestones occurred. The Hyper EVM mainnet launched in February 2025, which added smart contract functionality, programmability, and Ethereum compatible infrastructure, meaning Hyperliquid stopped being just an exchange and started becoming a broader blockchain ecosystem. On August 12th, 25, this one's for you, Farrell. Thank you for this. Anchorage Digital Bank announced that they were going to custody Hyperliquid's native token Hype. Anchorage announced that institutional custody support for Hype and Hyper EVM support, staking access, and institutional self-custody integration through Porto, and support for Hyperliquid's ecosystem assets. Then in November 21st, Anchorage doubled down and they expanded support by adding Hype staking, Hypercore support, and validator infrastructure through Figment. Even Circle bought stake in the company, and they went on record saying that they were seriously considering becoming a validator for them. However, with great power comes great responsibility. There was a major liquidation event, in case you guys were in a cave and didn't get to see it. It was one of the largest stress tests occurred, which was the good old 1010 last year. According to SEC filing disclosures, massive market volatility triggered huge liquidation and cascades, and over 19 billion leverage positions were liquidated across crypto markets. More than 1,000 Hyperliquid wallets were fully liquidated. So why does stress testing matter? Well, this tested liquidity depth, risk systems, matching infrastructure, liquidation mechanics. The protocol survived the event, which many traders viewed as proof of robustness under stress. But critics will argue that leverage system remains dangerous and cascading liquidations could still create a systemic risk. Some will also say that we need to have circuit breakers in place like TradFi does to avoid this from happening in the future. But even with 1010 Hype token, well, it became one of the strongest performing major crypto assets of 2025. Why? Because Hyperliquid generated real fees, real volume, real usage. And in late 2025, the protocol had one of its biggest upgrades. HIP-3 launched. This allowed anyone staking HYPE to create perpetual, sorry, very important I say this. This allowed for anyone staking enough HYPE to create perpetual futures markets permissionlessly. Hyperliquid instantly became more decentralized or open for market creation. And 2026, which, you know, we're only 5 months in, it's what's dubbed as the institutional era, which is our current phase. Hyperliquid is transitioning from crypto native phenomenon to institutional financial infrastructure. And there's a race, and that race is called the ETF race. And Hyperliquid is one of the first new generation protocols where issuers are aggressively racing to launch spot style products. The current HYPE ETF players, 21 shares, the first US listed Hyperliquid ETF product, ticker is THYP. ETF details is physically backed by HYPE, included staking mechanics, it's listed on the NASDAQ, and it launched in May. The launch reportedly generated roughly about 1.8 million in day one in volume, and 1.2 million inflows initially. And for a niche altcoin, the ETF, that's actually a respectable debut. There was Grayscale, which also filed for an S1 spot style ETF. The proposed ticker is GHYP, which would hold HYPE directly, list on NASDAQ, and provide traditional brokerage exposure to Hyperliquid. Bitwise filed for a spot HYPE ETF that would directly hold HYPE and trade under the ticker BHYP. One of the more interesting details, Bitwise announced it will allocate 10% of BHYP management fees to buy HYPE and hold on their company balance sheet, effectively creating a flywheel. The more AUM BHYP attracts, the more fees Bitwise collects. The more fees it collects, the more HYPE they buy, and the more HYPE they buy, the more the supply tightens. They've built a feedback loop into their own product, which in my personal opinion is genius. Bitwise is doing something else at the same time. They stake the HYPE tokens to earn more rewards, which then locks up tokens and reduces how many more are freely available in the market, increasing the balance sheet and allowing to potentially buy more and then repeating that process. The protocol itself is actually already doing this, which Bully already talked about. Hyperliquid generated nearly 40%. There are going to be a couple things I want to pause and just really hit home here. The protocol itself is already doing this. I just said that, but Hyperliquid generated nearly 40% of all blockchain fees last week, ahead of Ethereum at 14% and Solana at 10%. And the protocol routes the overwhelming majority of those fees straight back into the HYPE buybacks. So you now have 3 parallel buy pressures on the same asset. First, you have the protocol fees buying and burning HYPE on chain. You have the ETF staking awards compressing circulating supply, and you have Bitwise balance sheet accumulating HYPE with management fee revenue. It should come to no one's surprise that HYPE was roughly doubled in the price since the start of 2026, rising from $22 to over $44, reaching a top, and then today is 62, Wewo, right? Should I tell her she's muted?
You're muted.
Sorry, my little one woke up and she was crying. So $62 about that. Yes, $61.98. Yes.
I appreciate it. So at $44, it reached a top market cap of 10.6 billion in under 2 years of trading. That's just wild. But the number that not a lot of people are talking about, except for, and I'll shout out people when they deserve it, Alvarez for this one. A wallet linked to Andreessen Horowitz bought an additional 372,000 HYPE, worth roughly about 16.91 million, bringing a total accumulation since mid-April to approximately 90.87 million. Why do we think, the three of us, why do we think this matters? Well, the ETF thing. Hyperliquid is transitioning toward an institutional financial infrastructure asset. It's a massive shift. ETF issuers are basically saying there's enough liquidity, enough demand, enough market structure, and enough investor interest to package hype into traditional financial rails. They care about Hyperliquid because it's one of the largest decentralized derivative venues, one of the highest revenue generating crypto protocols with a serious on-chain trading infrastructure layer. The protocol reportedly processed hundreds of billion dollars in derivatives of volume in Q1. The really interesting angle, though, is Hyperliquid's ETFs are also happening during the rise of tokenized equities, on-chain perps, decentralized capital markets, and synthetic markets. You guys already wrote it in chat, I saw it earlier. A hot topic example is SpaceX. Platforms built on Hyperliquid have recently launched a speculative pre-IPO market. Now, what does that mean? Well, you can now bet, usually with leverage, on a price movement one way or another. But it's opening up liquidity corridors that traditionally have been only for the likes of venture capital firms, accredited investors, and private equity. Now coming on-chain globally 24/7. If Hyperliquid becomes the dominant on-chain derivative venue, the Binance of decentralized trading or a core layer of tokenized capital markets, then ETFs become a gateway for hedge funds, for RIAs, for traditional brokerage accounts, for retirement portfolios, for institutional allocators to gain exposure. Why the ETF race matters so much, guys, is because historically ETFs legitimize assets. They deepen liquidity, they expand access, they increase institutional visibility. Even filing activity alone often changes perception. The market starts asking, why are major asset managers fighting to launch this product? And it's not just ETFs. Hyperliquid also expanded into prediction markets, broader synthetic assets, macro-linked trading products. This signaled ambitions far beyond crypto-only derivatives. Now, during a geopolitical shitstorm, oil perpetual futures volumes surged on Hyperliquid. This demonstrates that traders are willing to use crypto-native rails for macro exposure, which I think is bullish. And one of the most overlooked milestones of Hyperliquid is the crypto traders can now speculate on products connected to the S&P 500 24/7, using perpetual futures on Hyperliquid instead of traditional stock exchanges. It's a massive symbolic shift because it hints at traditional financial benchmarks entering 24/7 on-chain infrastructure. And my last couple of pieces of 2026 that I'm going to throw at you, on March 2026, Ripple expanded the integration of Hyperliquid into its institutional prime brokerage. Ripple Prime, including HIP-3 perpetual markets, commodities, HIP-3 perpetual markets, commodities, oil, gold, silver, and traditional asset perpetuals on Hyperliquid. Institutions could now trade Hyperliquid perpetuals, access DeFi liquidity, and cross-margin positions. They could also manage crypto plus traditional assets together, including FX, fixed income, OTC swaps, and derivatives. Hyperliquid gained institutional access, institutional liquidity, institutional credibility, and more trading flow. Now, switching gears, Hyperliquid's builder program is also crushing it. Phantom, in under a year, has generated $20 million in revenue, all from users trading perps directly on the Phantom wallet. The top 10 builders combined have brought in $62 million to the ecosystem this year. And finally, Coinbase just dropped a big announcement with Hyperliquid. USDC is now the main stablecoin for trading on the platform, replacing most of Hyperliquid's native USDH. Coinbase even bought the USDH brand asset. So users basically don't notice a change. And as Wewo said earlier, all of what I just said in 5.5 years, 11 employees, 900 million in profit, and a $35 billion valuation. That's Hyperliquid.
Do you want to jump into this ecosystem?
I mean, more than I already did. We can list off some things, sure.
I don't know. I know that you did want it included. I don't know if there was something in there that you did want to.
Yeah, I want them to see what the different segments. I actually can't read that from here. So if you want to talk about the different things it has, that'd be great. I can't read it, unfortunately.
Yeah, no, I think it's just important that you can pay attention to the different protocols for the AI, the staking, the decentralized exchanges, even the NFTs they have in there, the stable coins is just kind of an expansion of the whole entire ecosystem.
She's a beast.
Mm-hmm.
All right. Now, compliance and regulations. You heard some good stuff, guys. You heard some good stuff. With all good, there's some bad. We will?
Yes. All right. So compliance and regulation. Let's see. So the team moved to Singapore in 2024. Pretty straightforward why. US regulatory stuff is too harsh over here for them. So I read an article by Yahoo Finance, and the article was titled Why I Wouldn't Touch Hyperliquid with a 10-Foot Pole. And so the only reason I like this article is because I kind of agree with it. Not that I wouldn't touch it. I'm not saying to buy or not to buy. I'm just saying the reasoning behind it. There's no KYC on Hyperliquid. So you just connect a wallet and trade. And for now, a lot of DeFi users, that's really great. But in the future with regulatory, from a regulatory standpoint, that could be a risk. So I just wanted to point that out. So essentially that's what they went through and they said is, with the regulatory structure coming for the United States, the KYC and the decentralized DeFi, that stuff might not be really good for, that. So just touch on that real quick. So something I do want to give them credit for as far as there's not a lot of regulatory stuff. Like sometimes we have ones that are really compliant and, I didn't find a whole lot for this, but in March 2025, Hyperliquid voluntarily removed wallet addresses linked to North Korea. And just real quick, do you guys know why we don't like wallets from North Korea? Well, there's a lot of hackers from that area. So the Lazarus group is known for hacking and stealing billions of dollars. So any North Korean addresses, not good. So they did that voluntarily. They didn't need somebody to step in and say, hey, what is this? Get rid of it. So it seems like they're trying to be very transparent and compliant on that side of things. And so like I touched on before, so I think they would fall under the classification for the Clarity Act as a commodity. But with the Clarity Act, I think they might have a little legality problem with the KYC stuff. So I guess we'll have to see what comes from that whole side of things. Do you guys want to add anything to the regulations stuff?
Got a couple things. So you want to do it first? You want to do it?
No, you go ahead. Oh.
Are you asking me?
Yeah, do you want to do it?
I mean, I have some questions, but you go ahead and.
Okay. So so yes, KYC 100%. It's also anti-money laundering, right? That's also part of it. That's
AML, yeah.
AML, right? So a couple things for that. So compliance tooling is starting to emerge for Hyperliquid. Blockchain intelligence firms are starting to come online. AML mining providers started supporting Hyperliquid tracking. An AML bot added Hyperliquid transaction tracing and sanction screening tools this year. Another thing that they are doing is they've gone on a lobbying structure, or like a policy that they're working on. Hyperliquid Policy Center was launched. It's led by Jake Chervinitsky. The organization argues that non-custodial front ends should not be forced into bank-style KYC rules, that financial privacy matters. Software developers should not become surveillance intermediaries. This shows that Hyperliquid is actively preparing for regulatory battles. For me, I try never to do like what I think it's doing, but the KYC and AML is absolutely 100% necessary for the market that they're in TradFi. It's just it's actually the most regulated of any financial. It just is. So they're probably going to take the banks. What the banks are doing right now against the Clarity Act is what I think they're going to do. So they're going to try to fight it, and then if option one doesn't, in my opinion, if option one doesn't work, they're going to go to option two, which is obviously regulation.
Yeah, which they'll either be banned or they'll be regulated. I mean, there's not going to be an in-between with these DEX styles exchanges, if you will. They're either going to comply or they'll be banned in the United States. So now my question to you is, do you think that if it's more highly regulated, do you think that it will lose some of that 75% of the decentralized exchange perpetuals? Or do you think that number grows, or do you think that number shrinks?
I think it depends on the way that they write it. Like it's if they could figure out if the decentralized leveraging aspect to it can actually coexist with the future financial regulations for it. You know what I'm saying? Because if there is no company that's tied to it, if there's no headquarters, if there's no identified like intermediaries in terms of these perpetual trades, then the regulations ends up becoming very sensitive to the decentralized aspect to this ecosystem.
So let me ask you another question. Why, in your opinion, is Hyperliquid so much more used than Coinbase or Kraken or Uphold or any of these other exchanges? Why do you think people gravitate towards Hyperledger? Do you think that it is because of the DEX style and the no KYC and the no AML? Whereas you have Coinbase, you have to do KYC, you have to be verified, you have know your person. Do you think that that's gonna? So this is and we're getting into more of like my issue with this one, but these are questions that I have, like, why are people so, why do they gravitate towards this? Yes, it's a great project, but what's going to change after regulation? Is it going to be more like a centralized exchange, and are people going to, where are we going to go from there? That's the only question I have. So regulatory, regulatory side of things changed my perspective on this token, because I was like, wow, this is banging, woo! And then I got to this point and I was like, oh, okay, well, we have something. And that's all I'm saying.
Love it.
Yeah.
Yeah. There's no question about it. There are two things about this project ecosystem protocol that you can look at and go, huh. And that's really a question, and that really a question of where you stand as an investor and what's important to you and whether you want to put your money into this. I agree.
And this is kind of what I've been screaming, like, since I've been on this platform, is people love the decentralized side of things, and it's great now, but as regulation steps in and starts, this is all going to change. It's all going to be very different in the future. That's all I'm saying.
All right. Bully, you want to say anything else about this?
No, I think I'm good to jump into TAM.
Let's do it.
Are we at that point in the night? Okay.
We are.
Let me just fix my screen here. Okay, let me
And thank you, Wewo.
I don't know if this is going to be a little difficult for you guys to read.
No, I can read all of it. Can you put it smaller, actually?
What?
Can we put it smaller?
Is he busting my balls right now? the numbers is what you got to pay attention to. Okay, but this is where the conversation starts to become very serious for this ecosystem very quickly, because we're talking about some of the largest financial markets on Earth, on the entire globe. Okay, and honestly, I think that some people still may not fully comprehend how large the derivatives market actually is, because I think when a lot of people first enter into crypto, they're usually thinking of the buying the coins, the spot trading, or the investing. But the deeper layer of global finance is really dominated by the derivatives infrastructure. So for the beginners out there, the derivatives are essentially just these financial contracts that are tied to the underlying asset itself, right? So this is going to include your futures, your options, your swaps, your perpetual trades, and your leveraging, okay? And that market's absolutely enormous. Now, on the top left, you could see that the global OTC derivatives market, according to the Bank of International Settlements, in 2025 was estimated to be around $846 trillion. That is trillions and trillions and trillions of dollars in these financial contracts. Now, obviously, that doesn't mean Hyperliquid is going to capture 846 trillion. I want to stay realistic, but it does show the size of the financial sector that Hyperliquid is positioning itself inside of, right? Because if Hyperliquid is fundamentally a trading infrastructure ecosystem, it's going to be heavily focused around the derivatives market. Now, on top of the OTC derivatives, you also have the global exchange traded derivatives. And according to the FIA, the Futures Industry Association, the global data for this it really reached about 12 billion contracts in a single month, which is only going to grow more globally. That's also a huge part to the core financial market. And then when we move into crypto derivatives specifically, these numbers are also large as well, okay? We're looking at around $20 trillion that was processed by centralized crypto derivative exchanges, okay? And that's industry reports within 2024, okay? But a lot of the crypto volume today is really dominated by the derivatives trading instead of the spot trading. So these centralized crypto derivative exchanges are processing somewhere around $20 trillion. And that's just inside of crypto alone. And then one of the biggest things that Hyperliquid is attempting to prove is that the decentralized infrastructure can actually compete for this type of activity. So according to DeFi Llama, Hyperliquid already processed multiple trillions of dollars in perpetual futures volumes. So at a certain point, the ecosystem has already reached hundreds of billions of dollars in the trading volume and billions in the stablecoin liquidity that's actually connected to the ecosystem, between 100 to 300 billion. Okay, and these are really big numbers for decentralized infrastructure, especially considering that this ecosystem is relatively young when you're comparing that to traditional financial markets. Now, I already mentioned the stablecoin liquidity, but these stablecoins are essentially becoming the settlement layer for the larger portions of the crypto trading infrastructure. Okay, so Hyperliquid has already accumulated billions of dollars in stablecoin liquidity across the ecosystem itself, which is really kind of critical for this ecosystem, because that liquidity in and of itself is going to create more efficiency. That efficiency is going to attract more traders. Those traders are going to attract the market makers. Those market makers are going to only deepen that liquidity even further. So that network kind of has a compounding effect to it as it scales within its size. And another thing that we could potentially talk about is the future potential of tokenized assets, right? You got the tokenized stocks, tokenized commodities, tokenized bonds. Eventually, the amount of value that's interacting on chain systems could be larger than where we kind of are right now, right? We've seen it reach potentially reaching into the trillions within the next 10 years. Inevitably, that could also tie into this ecosystem itself. But Hyperliquid is really kind of positioning itself as within one of the largest financial sectors on Earth. And if decentralized trading infrastructure continues to grow, then potentially it could become extremely more significant over time, whether or not that growth directly ties into the value capture for the token itself, that's just another conversation aspect to it. But we are looking at a pretty hefty TAM.
Do you mind if, are you all set, Bully? Do you mind if I
Please.
touch on a couple things? Okay, so I just wanted to touch on the flaws and the limitations to some of the things that were just mentioned. So it's not all peaches and cream and, it can go to the moon. So the first problem with total adjustable market is regulation can cap the growth. So I'll touch on that. I'm going to go through all the ones that I have, and then I'll touch on that one a little bit more. Most traders still use centralized exchanges, which will be in the end anyway. DeFi is still a little bit hard for beginners. Volume depends on active trading. Competition is pretty intense, so it's not the only one in this space. And institutional adoption is still pretty uncertain. So those are like the 6 things that can kind of, take away from a little bit of that. But let me touch on the regulation side of things, because this was interesting to me, because I didn't really understand that they could cap it, right? So I'm going to start right about here. So if rules tighten, regulators could require identity verification and restrict how much leverage is allowed, block certain countries from accessing derivatives, or pressure platform handling leveraging trading to allow stricter compliance rules. And if that happens, Hyperliquid could still operate, but the size of the market it can access may shrink, especially if fewer traders are able to or allowed to use leverage in the way that they can today. So, yeah, I thought that was interesting. So if rules tighten, platforms could face limits on leveraging, stronger KYC requirements, or country restrictions. That's pretty much it. So that could tighten that total adjustable market cap a little bit.
Inevitably impacting the amount that can move onto chain, let alone decentralized infrastructure. Yeah. So that's just another cascading reason why it's really important to pay attention to the regulations. Do you guys have somewhat of an idea of when they're going to really kind of hone in on the decentralized infrastructure in terms of the regulations? You think it could be the next thing that they look at?
So I feel like a lot of that is going to be part of, the Clarity Act, but
I can tell you that right
KYC.
now, this project is definitely in the bullseye of Clarity Act. That is an absolute guarantee. There's no way financial institutions and or government want this to just do whatever it wants.
So KYC and AML is going to be a big part of the Clarity Act, and you're going to see a lot of these. That's kind of what we're waiting for, to see what stays and what goes. Regulation is going to change everything, guys. It's going to change everything. But
good and bad.
Good and bad. I disagree with that. I think for some of us, it's going to be good who have positioned ourselves in a way to take advantage of this system. But I think in the end game of this system is definitely not good. Yeah. But
so back to value, sorry, go ahead. Keep going.
No, you're good.
I just wanted, there was a couple things you missed, Mr. Bully, for TAM.
Teach me.
Global Forex market, the FX market. It's like 7.5 trillion daily. It's a possibility that they can get into that. Tokenized real world assets. Tokenized stocks, bonds, treasuries, commodities, synthetic assets. Forecast by 2030 is 10 to 30 trillion. The prediction markets, which they're already in, is worth billions of dollars. I don't think there's anything else. Yeah, I think that's it. Like
I'm not sure
the
how much.
TAM for a project like this, if they survive the regulatory gauntlet they're about to go through, on the other side is it's definitely something that will be noticed.
I do just want to state that the FX is tied into the OTC derivatives market, but the FX is represented about 7 trillion. But it absolutely is a specific sector.
Bully, I'm sorry. Can you say that again?
Yeah, the FX market is representing probably around $7 trillion.
Really?
But it is tied into the global OTC derivatives market as well.
Yeah, it does overlap a little bit. And at this present moment, Hyperliquid does not touch any of that FX, none. But eventually, with everything that's coming, it will definitely overlap in for sure. If it, like Caveman said, is around after the
How does
regulatory
it
stuff.
attain value, Bully?
Oh, yay, let's
Yes. We see this, right?
do we have that one?
Okay. I always think that this is probably one of the most important parts of the entire episode, because this is where we stop and we actually stop talking about the ecosystem and we start talking about the token itself. And we are investors. If we're kind of, some of you guys maybe want to participate in the ecosystem, but we're looking to make money here, right? There tends to be a lot of, and I think that honestly, token value capture mechanics is something that I think all educators should really start to talk about a little bit more, right? Because these retail investors that we may see like massive liquidity or large partnerships or adoption, and they could automatically kind of assume that the token itself it has to benefit from that activity, but that's not always the truth. So this is kind of the moment where we really try to retrace and break ground and really figure out what is going on with the token itself for us as an investor, right? So we got to be pretty blunt about Hyperliquid and the Hype token. So the good news is that compared to a lot of crypto projects, Hype actually has a pretty strong foundation than most tokens that are kind of out there, right? Because this is a layer one, and it has a lot of users in there. There's a lot of liquidity. It's actual real financial infrastructure. That alone is going to separate it from the thousands of, and I'm going to say it, you guys may not like it, but the thousands of useless governance tokens and meme coins. I'm going to tie them to, right? I really do not like the governance tokens. So this is kind of where Hype could potentially capture value, but it's going to do it through the actual infrastructure layer, right? So because Hype is built with its own layer one blockchain, the Hype token is going to be connected directly to how that blockchain is tied in with the staking, the network security, the validator participation. Yes, there's governance in there as well, and also the future applications that could potentially be built on the chain. And that's really important to understand, because if the network itself is going to grow, then theoretically the importance of that native asset is going to go alongside with it. Now, another place where Hype could potentially capture value is really kind of honing in with the staking and the validators. So if these validators are securing the network, then that may prove that they may need to hold on to the Hype token over time. So theoretically, again, if the network activity grows, then the validator demand is going to grow along with it, and that could mechanically create demand for the token. Now, I'm going to go a little bit into the weaker side of the token mechanics, and I think that the biggest question within this ecosystem is, does all of the trading volume directly force demand for the Hype token itself? And the answer is no. No, not necessarily. There is there's some direct and some indirect, right? So the traders can use Hyperliquid and they can generate billions of dollars in the volume, but that trading activity doesn't actually require anyone to buy or hold on to the Hype token directly. And I say directly because that's the key word. So theoretically, those billions of dollars in the trading volume, yes, it's going to support the ecosystem through more staking, more governance, more network incentives, more validators, more applications. But those are all indirect effects of the more volume coming into the ecosystem. But I do want to pinpoint that that there is a difference between an indirect benefit and a forced value capture. So that trading volume that's flowing through the platform doesn't automatically mean that it's going to flow into the token. As we mentioned before, a lot of it is moving through stablecoins. Does that mean that it has a weak value capture model or a weak tokenomic? No, I actually think that the token mechanics are stronger here than most ecosystems that we have covered. I wouldn't put it in the absolute strongest forced demand value capture model in crypto either, but at least it's not the weakest. Okay, I think if Hyperliquid inevitably kind of had mechanisms where all of the fees would be like all of the fees would aggressively be bought back in the Hype token, or all of the trading activity would kind of be directly with the Hype token, then yeah, inevitably I could kind of see a stronger value capture model for it. But currently, a lot of the ecosystem activity is really benefiting the platform more directly than it is mathematically forcing demand for the token. So Hyperliquid still has a separation between a platform success and direct token demand. Over time, maybe it changes, but right now, it still has a very strong foundation. But the long-term strength of Hype, the Hype token itself, is really going to kind of depend on how much future ecosystem activity on Hyperliquid actually gets structured back into the token.
Can I just say one thing?
Yes, she's jumping to the mic. Spit it out.
It's definitely more than one thing. So I was just curious what Perplexity AI would say about just a score on value capture for Hyperliquid. Perplexity, I don't know if you guys are familiar
you're talking
with
about score?
Nope, not score, just the value capture score. This is only for value capture. So Perplexity is all the major AIs combined into one. So I really like that one sometimes. So they give it a 9.10 for value capture score. That's huge. So then I said, well, what is your top, assets for value capture, specifically only value capture? And it gave Hyperliquid as its number one, 9 out of 10. Said it would have been a 10 out of 10, except the only reason it's not a perfect 10 is Hype isn't required to place trades on the platform. Otherwise, it would be a 10 out of 10. I thought that was freaking really interesting. Second was BNB. Third was Aave. Fourth was Maker. Fifth was Ethereum. Sixth was Chainlink. Seventh was Ondo, which I don't know if I agree with that. 8 was Uniswap, and that's its breakdown. So I don't know, just some little interesting tidbits there. Take it with a grain of salt, but
Freaking fantastic.
I love that. That's actually
yeah, love it.
Let's do pros and cons before we bring up Evan.
I thought we were gonna do okay.
Pros and cons and evaluation models. Let's hear it.
Okay. Pros and cons. Do you want me to go first?
Yep.
Okay. For the good, I have Hype is deeply tied to its ecosystem through incentives, governments, and buybacks in the burn mechanism. March 2025, Hyperliquid voluntarily removed addresses from North Korea. 70% plus of the DEX prep market. $616 million in annualized revenue. 97% of those fees go to buying and burning. No VC, no insiders, no marketing budget. So the bad, hype is not required to trade. So Yahoo Finance, here's why I wouldn't touch Hyperliquid with a 10-foot pole. The first major problem, well, one major problem is the KYC and AML. It's heavy dependence on leveraging trading. A lot of Hyperliquid's volume comes from perpetual futures. So essentially the concern is that if traders stop using leverage during slow markets, the volume revenue could fall. Hyperliquid is not battle tested, so it's fairly new. DeFi carries smart contract platform risks. Even strong projects can have exploits, bridge issues, and liquidation cascades. Token valuation may be running ahead of its fundamentals, which is what we were talking about earlier. The market may already be pricing in a lot of future success. So, okay. And so the ugly for me, this was really bad. In March 2025, a trader opened a large short position on a token called Jelly. Then the trader pumped the price of Jelly to try to force Hyperliquid's liquidity vault, called the HLP, to absorb massive losses. The idea was to break the vault and cause a cascade. When that happened, the validators voted to delist Jelly and settle the position at the price that was favorable to the vault. It worked. The vault was protected, but critics immediately pointed to a real contradiction. A platform that markets itself as decentralized just made a very centralized decision at the exact moment it mattered the most. 13 validators made a call that affected anyone on the platform. And the Binance and OKX listed Jelly futures the same day that all of this went down. A lot of people in the space saw that as a coordinated attack on Hyperliquid and not so much a coincidence. And so did we ever touch on that there's only 16 validators for Hyperliquid?
Thank you.
That too. It's kind of a concern for me anyway. Yeah, so that's the good and the bad and the ugly for me.
Thank you, Wewo. And Bully?
Here I come. Short and sweet, guys. There's real infrastructure tied to the ecosystem. The trading on here is really strong. There is really deep liquidity compared to some of these other projects. They have their own layer one, and the adoption is growing, right? The downside is that the volume, the trading volume doesn't create a forced demand for the hype token, which is fine. I think that there could be some regulatory risks, right? We didn't go into the competition, but that's okay. I think that overall that there is competition in terms of the entire DeFi space, and I'm gonna go with that. Caveman, run us through it.
Okay, so we reached the point where I try to challenge us to stray away from market cap and as an evaluation tool and to take a look at other models that have consistently helped me to evaluate other protocol and coins on this show and to break down their evaluation. And the three things are Metcalfe's law, MVT ratio analysis, and velocity theory. So first, for people who haven't been here before, Metcalfe's law is the network effect, which asks one simple question: does a network become more valuable as more users or networks join? This is a tiered evaluation for Hyperliquid. There's a trader network effect: more traders, tighter spreads, deeper liquidity, better execution. It attracts traders again. There's the liquidity network effect, which more liquidity is lower slippage, better market depth, larger possible positions or larger positions possible. Institutional and pro traders become more comfortable trading here with more liquidity and favorable environment. There's the market maker network effect, which as volume increased, professional market makers joined, liquidity improved, and spreads tightened. More traders migrated from DYDX, from Binance, and from Bybit. And then there's the ecosystem network effect. The Hyper EVM plus HIP3 expanded the ecosystem beyond just perp trading. Now builders can create apps, markets, integrations, and new pairs. This increases the ecosystem stickiness. Hyperliquid has one of the strongest real network effects currently existing. Hyperliquid has one of the strongest real network effects currently existing in crypto trading. The NVT ratio analysis is the second model. What that means is the token valuation justified by the actual economic activity? So in simple terms, NVT is network value divided by transaction volume. So a high NVT is possibly an overvalued or speculative asset. A low NVT is a stronger real usage or value flow. Hyperliquid generates massive real trading volume, real fees with real revenue and real on-chain activity. At times, Hyperliquid reportedly generated more on-chain fee revenue than most major L1s. Hyperliquid has unusually strong real economic throughput supporting the token, but trading activity remains cyclical and speculative to what Wewo was talking about earlier. And the last one is the velocity model analysis. But what that is does the token get held or is it immediately sold and spent? In simple terms, velocity equals transaction volume divided by the average token supply. So if you have a high velocity, tokens are constantly sold and flipped, weaker long-term value capture. In a lower velocity, it's more holding, staking, locking, stronger scarcity dynamics. Staking reduces velocity. It locks supply. It removes circulating liquidity, incentivizes holding. The treasury and the ETF accumulation. Examples are Bitwise BHYPT ETF, the treasury holdings, which I will get back to. Thank you to Money Talks for this. And the ecosystem reserves and the protocol-owned positions, which help reduce the free floating supply. Buyback mechanisms matter because protocol fee buybacks create recurring demand and long-term accumulation pressure. One negative is the token, as Bully just said, is it's not needed for trading necessarily, which obviously is not a great thing. So that is what I have regarding the evaluation models. I didn't give you any numbers for obvious reasons. We'd like to bring up the man, the myth.
Let's get him up here.
Change our minds.
Oh, shucks, my video's off. Man, thank you guys for having me so much. Here it comes. Hang on. Nice to be here with you. I've loved the conversation so far.
Thanks, Evan. Appreciate that.
Yeah, thank you guys for having me.
Of
Is
course.
my audio okay?
Fantastic.
Perfect.
Okay.
Thank you for being here.
Yeah. Don't let me derail you. If you ask me a question, I didn't hear it as I was connecting. And if not, please continue, and I'll just jump right in where you tell me.
So, Evan, is there anything that we said? Is there anything that you that glares at you immediately, where it's like, hey, you know what? Have you ever thought of it this way? Or actually, you guys were totally wrong.
You guys made excellent points about pretty much everything all night, and there was a lot of stuff that I learned from, a lot of stuff that I enjoyed engaging with and wanted to engage with. I will just quickly catch you up to my take that I agree with Perplexity and many other opinions. My own opinion is that Hype, the token, has some of the best token market fit we've ever seen in crypto. Because even though Hype is not the primary token used to trade and settle, every trade generates activity that leads to meaningful burning or meaningful reacquisition of that token. And people love to trade on Hyperliquid. More people are trading there all the time. And it all goes back to this mechanism that makes the token, in a world where people are investing in, I don't know, VeChain or ICP because of the value it might have someday. The value this is generating and capturing with this new instrument right now is immense and powerful. It's not speculative, it's real. So that's my observation. I also share a lot of the concerns, because especially the centralization, huge concern. if they have the key to turn things on and off and will use it, I don't like that. I also am curious about how they will fare in a future where laws might change. But the question I wanted to ask, actually, if I could, is you shared just some of your concerns about, I think you said, you will use a centralized exchange. You believe, I'm reframing, that the future we are headed towards, it seems more likely than not that protocols like this will be outcompeted, maybe because the laws change. Is that like an accurate representation at the base level?
I think it's an accurate representation. I think that where we're going, the DEX side of things, it's not going to be there so much anymore because of regulation. I feel like we're living in like the wild, wild west. That's a key term we hear in this, space a lot. We live in the wild, wild west. And I think with regulation, when that comes in, these DEX styles exchanges where it's, willy-nilly, you can buy and sell and trade and swap, however you want. I do think that's going to go away. I think it's going to be a lot more regulated, like the stock market. It's going to be more, yeah, I think it's going to be more regulated for sure.
Okay. Thank you for taking the time to explain. I agree with you. I tend to think, though, you mentioned, who said it, Jake Chervinsky is now doing legal over there. He's a storied law hero in the crypto space. He helped with the Tornado Cash suits, the Uniswap suit. I mean, we all owe him dinner someday. He's doing great work. But I am inclined to think, just based on history, Bitcoin survived, Ethereum survived, Tornado Cash as code is surviving, even though the front end, who knows. So I think probably front ends will be regulated. The custodians, definitely. We're going to see KYC layers. I could see APIs being regulated in some significantly different than DeFi now way. But I don't think the matching engine of Hyperliquid, like the actual order book, hypothetically, it's an open network. And as more people care about it, more validators can gain a significant share. I've seen that happen over time in many other networks, Solana, Ethereum, Bitcoin. And I don't think they're going to be able to regulate the messages, the hashes, the cryptography. They could. That would change my mind. But I don't think any of those things that make Hyperliquid the protocol what it is would change. And even in a world where the KYC AML thing exists, because it does now, people prefer the on-chain nature of the Hyperliquid product. And my thing is that you're not going to regulate they don't regulate a protocol. They regulate the business that's built on top of it. So I guess I'm watching for that, but I am hopeful. I don't think the Clarity Act or anything else is going to cause a condition that will allow Hyperliquid to be legally outcompeted. And if it does, I feel like we'll see it coming long enough away to take profit and get out kind of thing. But the soup of it, the ingredients of it, and the actual money that's there now and the interest that's there. I mean, the stock market people want to use Hyperliquid because it does what they already do better. So I think they're going to find a way to use it, even if it's compliant, that will benefit probably people who hold the token. So I didn't want to push back on anything, but I wanted to invite dialogue around that because that's my big thing is I'm concerned about it too. I think it's likely to play out this way, and I want to know what you think. Because I think the Hype token, don't sell your house and buy it, but I'm certainly looking to add some. It's the best token market fit I've ever seen. And if I am going to spend my money on Pengu tokens, the heck am I doing not buying this? You know what I mean? Kind of thing. I don't have Pengu, by the way, but
I want to say something that's going to be pretty, I'm really trying to temper my enthusiasm, but I want to say something that is going to be pretty clickbaity. Sorry, I apologize. It really is. So in my opinion only, I see Hyperliquid in the same view I see what Ripple is creating, just coming at it from completely different sides of from different ways of doing it, but ending up in the same spot. And I think that, and I'm not trying to say hey, buy Ripple. I'm saying that this is almost too big to fail for Hyperliquid, in my opinion. I think that it is a project that if like in the new now does it exist in its entirety as we know it now, or is Circle coming in and buying stake in it a way to potentially, maybe move the needle one way or another? Because they did do that, and
That was huge.
they probably did it for a reason that's beyond just like, hey, we need some money right now. They don't need the money, but they probably need the backing of a real institution in fintech.
Well, and that's a good point because Circle is kind of like Brian Armstrong and Coinbase and Circle. That's peanut butter and jelly. And he has a vested interest in getting that product into as many people's hands as possible. Hyperliquid had a very notorious, they've had a couple of big PR incidents. One of them was when they said, we're going to do our own native stablecoin. They incubated the project. They decided to use that as a way to try to capture more fees and value and, support a home team or whatever. But it generated a lot of publicity because everybody submitted a proposal. Everyone wanted to use their token for Hyperliquid's volume. So when USDC and Hyperliquid, when that announcement happened, it's basically like saying like, that was a fun experiment. We're going to step aside and take this thing in a big way, put our money where our mouth is. It'll get them more exposure, better rates for their customers who are doing futures or whatever. They'll be the front door to that DeFi ecosystem, capture their cut of the fees. And Brian Armstrong is going to shake a lot of senators' hands and say, we just need to get this bill passed in whatever direction he pays them to do it. You know what I mean? Like he's a bishop on the chessboard, I feel like. But it's uncontested. So much could happen. But what's happening now?
Even though what's happening now, even what's happening right now on that chain.
Yeah, the word utility gets a bad rap, but if I've ever seen it, this is about as close as it gets to me.
Like, stop watching the show, guys. If you don't like this show, if you don't like this coin, then you do not like utility, and you do not like utility unlocked. I can't say it any clearer than that. That's just the truth. There you go. There's my rant.
I've been really curious all night to hear what people would say. All the points are so good. I look forward to seeing where you grade it, and I feel bad because I probably would have been a better contributor to the conversation throughout, but I really, really enjoyed listening to you guys. This is a great episode. I've been begging for hype in the comments because I think it has such good token market fit, and I will say to the viewers at home watching, hello. It kills my heart a little bit inside that you would want to spend 2.5 hours on internet computer protocol. No shade. Love the tech. In a world where Hyperliquid is actively like eating a very fast-paced startup space. Well, I don't know. Where's ICP? Did they show up today? You know what I mean? Like they're snoozing somewhere.
Evan,
again,
could I ask you what does Hyperliquid realistically look like in 5 years if everything does go right with them?
If everything goes right with them, then you're going to be able to trade more stocks, commodities, other kinds of assets. Real world assets that we talk about are going to have much more tradability because of the environment, the wrapper that Hyperliquid would give them. And we talk about sometimes velocity of money. One of the reasons people are interested in something like Hyperliquid, whether it's Aster or, Jito is a sponsor of our show, and they're trying to build a trading experience like it. Everyone's trying to crack this nut because all the Wall Street people, all the fintech people, all the RWA people, they want this kind of wrapper to give their assets this kind of liquidity and velocity so that as soon as the Strait of Hormuz says, hey, we're going to do this now, whether the market is open or closed, not only can you trade it without needing to own it, but you can amplify your impact with other people's money that you borrow, leverage. Like that is what all of these companies and people want. It's super risky, but there is a place for it in markets. And in terms of markets, by definition, a solution to match people who want to buy, sell, share information. This is a very efficient market. So I could see it not only capturing more of the crypto market share if it succeeds, but more of what we call trading activity. It's going to happen on chain. And at least for the next chapter, if Hyperliquid succeeds, it will happen in an increasing way on Hyperliquid, the way TradFi has increasingly moved to tokenize stuff on ETH. But I think faster.
Can I give you a follow-up? What do you think is probably the biggest hidden risk about the Hyperliquid ecosystem that nobody's kind of paying attention to or talking about right now?
I think the usability is something to pay attention to. You had questions earlier. Where can I buy it? I live in New York. They don't sell it on Gemini. If you want to use it on chain, it's a crypto native product. You got to bridge assets to Arbitrum, probably have some ETH on Arbitrum for gas, know how to use a bridge, know how to get it over there, swap it for USDC or whatever else you want to trade. And then you got to be a pretty sophisticated trader to like get that, you know, it's not a beginner product, but just buying hype is hard. I think that retail is likely to be left out of that most. Again, the pro traders, they've already been there. The financial Wall Street TradFi guys, they are getting there or trying to get there as fast as they can. And you are the one who's left out of this experience. So I think that's not like a hidden thing, but it also creates there are lots of questions about the regulatory concerns of it because of how people have to interact with it. And I think regulating it would be like regulating thought. You know, crypto has survived, but that's a concern. It would change my mind if, I don't know, tomorrow a law was passed and World Liberty Finance got like, I don't know, $100 billion of Tether and $100 billion of USDC. You know what I mean? It was like basically every customer from Visa, Amazon, whatever has to use ours now. Like it'd be hard to compete in a world where that happened. And honestly, something like that could happen. But we'd see it coming from far enough away. I think that the other things falling away would be noticeable.
So I will just say one thing. One time I've been happy to being a Canadian in the crypto world. You can actually buy hype on Coinbase in Canada.
Hey.
What? Ding, ding, ding. Now here's a question.
Kraken, Gemini, Robinhood.
Here's a question. Can you buy it? Pardon, sorry, say it again, Weebo.
It says Kraken, Gemini, and Robinhood. I don't know about Coinbase. I can't look on my phone because I'm on my phone, but I don't know about Coinbase in the US. Do you know, Evan?
I have to say, I don't. That's where I would go first if I wanted to buy it, would be Coinbase, and then I'd go to Kraken. And I've got to imagine that unless you live in New York or something like that, which, sorry, friends, the reason Coinbase and Kraken can keep you from doing that, even with a VPN, is because you signed up with your license. You told them where you lived. So I will find out, though. We can all find out together.
Yeah.
Okay, so I have a few questions. It's to the three of you. It's from chat over the course of the show, if that's okay. The first one was regarding PURR, P-U-R-R. I did miss it in my breakdown. Do you want to take that, Evan?
PURR is a Hyperliquid DAT. A DAT is a digital asset treasury. You'll start to hear that word if you haven't. Companies like MicroStrategy are DATs. They use their assets on hand to acquire crypto assets, Bitcoin. And then based on the value of those assets appreciating, they issue more shares. When people buy their shares, they use the money to buy more crypto assets. PURR does that with Hyperliquid. And the effect, just as you do your research to see why would I pay attention to this, is to watch the price lines and how they move. How PURR creates a sort of amplified exposure and a sort of delayed exposure to the movement of, you think they just move together, but they don't. And understanding that will help you understand other DATs too. Digital Asset Treasury, PURR. And it's a stock. So you would buy the stock. Yeah.
This guy's a freaking home run, let me tell you.
And they leverage, is it leveraging, Evan? Like,
no, it's like MicroStrategy. They buy the asset, issue more stocks, and use the money that you pay them for the stock to buy more of the asset. They all have like a slightly different secret sauce in terms of how they buy and when they buy to guarantee a return or whatever. Michael Saylor just offered like 4 new products that do this a little differently. So, you know, but there's no leverage this time.
It also was the original like meme coin, right?
PURR. Yeah, there is a meme token on, I think it's on Hyperliquid that's PURR, although I think it's Hyper. Don't quote me on that. It's been a long time since I looked into that, but you know, could be the move.
Okay, so the next one was Hester. Hester Pierce said no synthetics would be allowed. What?
I'm sorry, I don't understand.
So synthetic trading in the few, I guess after regulation, no synthetics would be allowed.
Where'd she say it? Can I look it up?
I mean, now this was a statement / question, so that is a good question.
That seems like it seems. Crypto Mom Hester Pierce excludes synthetic tokenized. stocks from SEC exemption. She said, narrowed the scope of the agency's innovation exemption for tokenized stocks. Oh, this is what she's talking about. She's saying that if you buy pre-IPO stock in SpaceX or something else, what you really effectively are buying is like some guy in the Cayman Islands, his entity owns like an allocation of this stock. It doesn't exist yet. It's not his yet, but he's like, you know what? I'm going to tokenize this or whatever. And each token is a share of my stocks. And you can buy this from me. And when it comes in, you know, it's a synthetic instrument, an asset that, but there's like 9 layers of synthetics between that Kraken token you bought and actual SpaceX stock. So what Hester Peirce is talking about is she's saying, we don't think that's worth an innovation exemption just because I don't know, she thinks it's a little too close to maybe like vaporware. I kind of agree. I think there are a lot of ways to get scammed along the way. I know someone who's trying to build in that space right now, and I don't know. I don't have a good argument for it personally, but it could just be my shortcoming.
Thank you. Do you have anything to say to that, Bully or Weo?
No, I honestly didn't know anything about it.
I had no idea either. So thank you. Yeah, no, it's exactly what he said. It's just like a ghost or a mirror token that doesn't, it's not even tied to it really. It's synthetic. Synthetic means not real, right? Yeah.
It's like these ETH derivatives that we saw in that big DeFi exploit. RSETH is a token on Aave that got basically spoofed and withdrawn against real ETH tokens. So it's very interesting, the concept of like what we can do to give money a wrapper or information a wrapper on chain. You could really do some crazy fun stuff. And I think some of it is novel and will be helpful, but I personally think pre-IPO tokens are mostly a way to make Cayman Carl rich.
The last question was regarding hyperfabric connection to Hyperliquid.
The hyperfabric, like the actual hyperfabric.
Yeah, yes. I'm gonna go with maybe.
I'm probably gonna say no, but I could definitely look it up.
Yeah, I'm looking. I've never. I see Cisco Nexus Hyperfabric, a data center product, but I don't believe there's any relation. If there is, I'd like to learn about it. Hyperfabric, Hyperliquid. It sounds like we're super hyperfragilistic expialidocious. You know.
No relation.
Okay, so we're gonna go no. Okay, before we do the little score, do you guys have anything else you want to add?
I would just say thank you again. I love getting to hang out with you guys. The backgrounds look great. The show was excellent. Finally, some justice in the chat for the hype stands.
Evan, no, stick around because you're going to give your score as well.
Great.
We want your score too.
No, I was planning to. I just wanted to thank you in case I forgot later. Go over the rules again. Tell us how we're supposed to score.
You can score whatever you want to give it. You can give your the pros and cons, little wrap up.
I'll be brief.
Yeah, exactly. Bully, we'll go start with Bully. Go to Wewo, me, then Evan. Bully?
I'm actually going to give it a pretty decent score. I'm going to go with an 8. Going with an 8 for it, which might have been one of the highest that I have scored so far.
So it was one of the highest. I think it might have been the highest for me, and it was a 7.8. Yeah, super strong. I feel like it's got, great potential. I do a weighted score, so of course it's over pretty much everything that we've talked about. The technology, the team, the tokenomics, the compliance, the adoption, the ecosystem, and community trust. But I will say, as regulations roll out and we kind of see this landscape changing and evolving, my score could change a little bit. And I just want to clarify, with regulation, I don't necessarily see this going away completely. I'm just seeing it being a little bit more capped, if you will. I don't think that they're going to allow it to go crazy, but I still think it's a strong competitor, and I would like to see where it goes. I will probably, have a bag.
Clip it.
Okay. So, I wrote something for you because I really wanted to make my sentiment clear. The regulation pitfall scares the bejeebies out of me. And I also don't love the fact that that users of the system don't have to use hype. But I am absolutely willing to take the trade-off. We didn't rate projects at the inception of this show, so Hyperliquid gets my highest rating to date. I gave it an 8 out of 10, and I have a note here saying Evan might convince me to go to 8.5. I don't know. Maybe I could be 8.5. We'll see at the end of this if I give it an 8.5. But I'm definitely an 8. Full disclaimer, I now own and will continue to acquire hype. I'm not in any way telling you guys to, because lawmakers and TradFire are going to be gigantic obstacles. But I do want to thank the Rums community for bringing this to my attention a while ago. I also want to thank Consensus for the Hyperliquid panel discussion, which was amazing. And more importantly, you guys for forcing me to look behind the curtains of Hyperliquid, because I wouldn't have done it if it wasn't for you guys last week. So I am all in.
Man, what an endorsement. Good for you, chat. Everybody who watches this show wins on that one. That's good. I want to ask you a question before I give my score, which is, you guys said this earlier. I think, Bully, you said it, and Dan, you said it just now about why you don't like it that they don't use hype as like the trading token. I'm curious about why, because that's not a big deal for me. I in fact glad that they don't. I think, but I'm open to learning.
Because of bottlenecking.
I'm glad they don't, because I think stablecoins are a better trading instrument and settling instrument, and it creates more friction to make people use hype token to do their trading with. And the fees are still accruing the same way. Like we wouldn't get any more fees or like juice out of the tokenomics if they used hype. I think they would just add friction. Personally, they would deepen the liquidity for it, but the liquidity is already so deep. And they want it to be deep with stablecoins. If I'm hype, I want hype, but I also want stablecoins. I need as many stablecoins as you can give me to do the job of settling.
This is actually a much deeper conversation. If it had its own like pool that you could go in and out of, you know what I'm saying?
Yeah. You could definitely make fees that way too.
Right. It is just. That's the only thing I would say, where now you can go from you don't have to USDC. You can use whatever you want, come into hype, come back out with USDC. That way it's always the same, what you're talking about. I completely agree. You can't just use hype. That's all, because it's too volatile. So in that case, I agree. Now, with regards to the question of like bottlenecking, I mean, that just increases the price of the token, in my opinion.
Got it.
Yeah, I think it was just important to kind of explain it to the people that the represented value that is kind of transacting here doesn't necessarily force a direct demand to the token. Of course, it's going to do it through validators and fees and actual ecosystem participation. But the actual transaction is really kind of focusing really more on the stablecoins. And I agree with you. That's kind of where we are moving into, but I wanted to kind of separate the idea that when people see a headline of however many billions, it's not necessarily flowing directly into the token.
Are you familiar with like the way that they do it, the formula? I thought I heard you explain it earlier, but I understand it to be about as direct as it gets. That's when I say token market fit, I mean like when there is trading volume, the protocol makes fees, and the fees are routed to something called the assistance fund. It's a smart contract. They hold the keys to it, so they could change this, but it's against their interest because it drives up the value of the token, which benefits everyone. That they do hype buybacks, like money gets deposited in the treasury and some of it is used for the buybacks. And that is the thing. Taking hype off the market in correlation to how much people use the platform is what causes the buyback and removal of circulation. Direct buy pressure. You know, if it makes $3 million into the fund, then that's like almost $3 million of pressure. You lose a little because there are fees there too. But it's direct.
It's actually fantastic. Every protocol should look at what they're doing and take a minute. take a minute and you just be like, there. Now, the reason is it's selfless. It starts with the people in charge at the very beginning.
Now, Evan, are you saying that all of the fees are 100% bought back in the hype token?
It's not every single fee, but it's significant. It's a significant port. It's not just like 0.001. It's like it's the most aggressive buyback policy in crypto. I could get the math on it if you give me 30 seconds.
Yeah, please.
But it's, yeah. It might be hard. I don't have a DeFi Llama Pro. Let's see what I can find. So I would consider Oak Research to be a strong source. They report on-chain activity, Oak Research IO. I was in a funding round with them for Octave. They're great. It looks like they've got, oh my gosh, is it Solom, the Chief Gift Officer? Good to see you.
CGO.
Let's see.
It's so great.
That's right. That's right.
CGO. I'm gonna change his name in my phone.
So I will tell you another thing that concerns me is that on slow days, open interest does fall, and it's not like it's still the best performing token in crypto in terms of revenue by far, like even on its slow days, but it does have slow days. It's not immune to the market. There's less open interest than there was at the peak. Technical context, TV, I like TV. You might have to go to another question and then come back to me and I will give you better numbers. Fair?
Well, I mean, I would.
Oh no, it's my score. Jeez.
We're done.
Okay. Sorry guys, it's not my show. Forget that. Don't let me hold you up.
Yeah.
Check that out for yourself, and I will check it out too, and I will tell you how I do. So maybe we can trade tools and get a new tool in our tool belt. For now, I am giving Hype, just like Perplexity did, as a protocol and as a token. I'm giving it a 9.6, which would probably be one of my higher ratings. It's my first time.
I love it.
Say that again. What is it? I was reading and I'm focused now. I apologize.
It's okay. I, like Perplexity, gave it a 9.6 as a protocol, as a token. I share the concerns, but it's hot. And I'm not an owner actually, and I'm a little salty about it. I was building the conviction to buy, and then mostly just being busy doing other things because it is difficult to acquire. And I was like, let me just focus on, I was swing trading some ETH at the time, and that was going pretty well. I don't like to do too much. So I was waiting as I was watching for it to touch like 20 again. At the time, I was like, oh, 20 is the buy. And it never touched 20 again. And I've been waiting this whole time for the last, 8 months or whatever to see it do something. And I just have to adjust my expectations. I will probably start buying again, dollar cost averaging, as it gets closer to 40. But I don't know. It's just, I will probably buy. Might change.
Wait, what wasn't it? Oh yeah. What was it? 41 of 98 today, I think. Well, before we started, I think it was around there.
Yeah.
Let's see where was it.
I saw it
at. Oh no, it's 61.98.
52 was the lowest I saw it at in the last, little while. So ways to go. But
no,
I
like that take on it. Yeah. Have to do a chart analysis on it and see what a good entry is now.
Yeah. Can I drop back down to do the vote and participate?
Absolutely.
Oh my gosh. Excellent. Thank you so much for inviting me. I'm here anytime for anybody. If you're seeing me for the first time, my name is Evan. I help people understand crypto. And if you have questions, they're welcome on my page or in the community at my bio anytime. Hope to see you on a live show. And if not, I'll see you in the audience here. Bye for now.